0-100 to 0-30. Hook. Show phone. Dividend deposit notification. $500 a month. Every month. Just sitting in my account. And I'm going to tell you something that most dividend investing videos don't say. You do not need $500,000 to get there. In fact, depending on your starting point, you can reach $500 per month in dividends in 3 years. I'm going to walk you through the exact portfolio I built, the tickers, the math, and the compounding schedule that gets you there faster than you probably think. 0-30 to 130. Intro. Dividend investing gets a bad reputation in some finance circles because people compare dividend yield to total return and declare dividends inefficient. That argument is technically valid but practically incomplete. Today we're not going to debate dividend investing philosophy. We're going to talk about how to build a portfolio that generates $500 per month in real deposited cash, and do it in a way that doesn't sacrifice long-term wealth building. What we're covering: why dividend investing works even in a lower yield environment, the 3 ETF core that I use, SCHD, JEPI, and 1 growth tilt fund, the compound reinvestment table that shows exactly when you hit $500 per month, how to screen individual dividend stocks for safety, and the tax treatment that most dividend investors get wrong. 130 to 330. Why dividend investing works. First, the honest framing. Dividends are not free money. When a company pays a $1 dividend, the stock price drops by approximately $1 on the ex-dividend date. You received value that was already in the stock. This is the argument dividend skeptics make, and it's correct as far as it goes. But here's what the total return argument misses in practice. Most investors need behavioral structure to stay invested. Dividend income creates a visible, regular cash flow that makes the portfolio feel productive during bear markets. Investors who see $400 deposited in February 2023, while the market is down, are significantly less likely to sell their positions than investors who see only unrealized losses. Dividend income is partly a psychological technology, and its value should not be underestimated. Second, forced reinvestment at market prices. When you reinvest dividends automatically, you are dollar cost averaging into your position with each payment. During a market decline, your dividends buy more shares. This mechanically amplifies the DCA effect. Third, income growth compounds. A stock that raises its dividend 7% per year will double its per share payout in approximately 10 years. If you build a portfolio of companies with a long history of dividend growth, your income stream increases every year without you investing additional capital. 330 to 530. The 3 ETF core. Here's the portfolio I use. Structured for $500 per month income in a reasonable accumulation timeframe. SCHD. Schwab US Dividend Equity ETF. 60% of portfolio. SCHD is the foundation. It tracks the Dow Jones US Dividend 100 Index. 100 stocks selected for dividend consistency, yield, and balance sheet strength. Current yield, approximately 3.4%. 5-year dividend growth rate, approximately 11% annually. Expense ratio, 0.06%. This is the quality and growth engine of the portfolio. JEPI, JP Morgan Equity Premium Income ETF. 30% of portfolio. JEPI generates income through a combination of dividend-paying stocks and covered call option writing. The fund sells calls, not you. Current yield, approximately 7.5%. The trade-off: JEPI sacrifices significant upside participation in bull markets because the covered calls cap gains. During 2023-2024, when the market surged, JEPI underperformed total return. But JEPI generates reliable monthly income, which accelerates the compounding cycle and is valuable during accumulation. DGRO. iShares Core Dividend Growth ETF. 10% of portfolio. DGRO focuses on dividend growth rather than current yield. Current yield approximately 2.2%, selecting companies that have grown dividends for at least 5 consecutive years. This tilt toward growth companies adds quality earnings exposure and reduces sector concentration in utilities and REITs that can dominate pure yield portfolios. Small allocation but meaningful as a growth counterbalance. Blended portfolio yield on this allocation. Approximately 5.1%. 530 to 730. The compounding table. When you hit $500 per month. Show spreadsheet. Here's the math that actually matters. Starting capital. $0. Monthly contribution. $500 invested. In addition to dividends reinvested. Blended yield. 5.1%. Dividend growth rate. 7% per year. Total annual return assumption. 9%. Year 1. Portfolio value approximately $6,150. Monthly dividend income. $26. Year 2. Portfolio value approximately $13,600. Monthly dividend income. $58. Year 3. Portfolio value approximately $22,800. Monthly dividend income. $97. Year 4. Portfolio value approximately $34,000. Monthly dividend income. $145. Year 5. Portfolio value approximately $47,500. Monthly dividend income. $202. Year 7. Portfolio value approximately $82,000. Monthly dividend income. $349. Year 9. Portfolio value approximately $128,000. Monthly dividend income. $546. At year 9 with $500 per month in contributions and dividends reinvested. $500 plus per month in dividend income. The $500 per month milestone is achievable in roughly 9 years at this contribution rate. If you have a lump sum to start, beginning with $30,000 and contributing $500 per month accelerates this to approximately 5 to 6 years. If you can contribute $1,000 per month, the $500 per month income milestone arrives in approximately 6 to 7 years from zero. 730 to 930. Screening for dividend safety. The biggest mistake dividend investors make is chasing yield. A stock yielding 10% is almost always either cutting its dividend in financial distress or priced that way because the market expects bad news. High yield is a warning sign, not an opportunity. How to screen for dividend safety in individual stocks. If you want to go beyond ETFs. First, payout ratio. This is the percentage of earnings paid out as dividends. Under 60% for most industries is healthy. Under 75% for utilities and REITs, which have capital-intensive businesses and use more of earnings for dividends by design. A 90% plus payout ratio with no exceptional explanation is a red flag. Second, consecutive dividend increases. Companies with 10 plus years of consecutive dividend growth have demonstrated commitment to the dividend through multiple economic cycles. The dividend aristocrats, 25 plus years of consecutive increases, are the gold standard. SCHD and DGRO select for this automatically. Third, free cash flow coverage. Earnings can be manipulated. Free cash flow is harder to fake. You want the dividend covered by free cash flow, not just accounting earnings. A company paying $2 per share in dividends on $1.50 per share of free cash flow is burning through capital to maintain the payout. Fourth, debt to equity. Highly leveraged companies are dividend risk. When credit conditions tighten, over-leveraged dividend payers cut. First, look for D/E ratios under 1.5 for most industries. These screens are available on Seeking Alpha, Morningstar, and most brokerage screeners for free. 9:30 to 11:30. The tax treatment most investors get wrong. Dividend income is not all taxed the same way, and this matters significantly for your after-tax income calculation. Qualified dividends are taxed at the long-term capital gains rate, 0%, 15%, or 20% depending on your income. Most dividends from U.S. stocks held for more than 60 days before the ex-dividend date qualify. SCHD and DGRO primarily pay qualified dividends. Ordinary, non-qualified dividends are taxed as ordinary income at your marginal tax rate, which could be 22%, 24%, or higher. REITs and some funds pay ordinary dividends because of their special tax treatment at the entity level. JEPI's income distribution is partially ordinary and partially return of capital depending on the options component. The practical implication: dividend ETFs work best in tax-advantaged accounts. Roth IRA, traditional IRA. If you're in a high tax bracket, because your dividend income compounds without annual tax drag, in a taxable account with qualified dividends and a 15% capital gains rate, the drag is manageable. The SCHD and DGRO core of this portfolio should be in a Roth IRA if possible. If you're using a taxable account, the qualified dividend treatment still makes this viable. Just know your after-tax yield is lower than the stated yield. 11:30 to 1300. CTA. Here's your action plan. 1. Open an account at M1 Finance or Fidelity. Both allow you to build a dividend portfolio with automatic investment and fractional shares. 2. Set up a dividend pie in M1 with 60% SCHD, 30% JEPI, 10% DGRO. 3. Enable automatic dividend reinvestment. 4. Contribute consistently and don't look at monthly income numbers for the first year. They will be small, and that's correct. I've linked the M1 Finance affiliate in the description. It's the platform I actually use for this portfolio. The dividend tracker spreadsheet I showed is also linked. No email needed. Subscribe for 2 daily videos on investing, passive income, and personal finance with real numbers. And if you're already building a dividend portfolio, comment what your current monthly income is. I love seeing where people are in the journey.